Hey there, welcome to the first episode of this series where we will be going through A to Z of depreciation, what it is, how to get more, how to help it affect you and help your business in a better way from beginning till end. We'll cover real estate professional status, we'll cover some of the passive activity laws, we'll cover recapture tax, we will cover the short-term rental loophole, cost segregation, all the good things. Excited to see how this plays out. But let's start with depreciation. Too many times I find that a client or prospect doesn't even know what depreciation is. We're busy talking about cost segregation and accelerated depreciation, and they don't really fully grasp depreciation. And this leads them to thinking things that, like, if they do a cost seg, they won't have any depreciation left. Just not understanding the different parts. So that's why I wanted to start this series. We're going to build from the ground up, so this way you could understand uh, these concepts better, and you could better leverage them to help your situation out. All right. So first off, what is depreciation? So depreciation is effectively taking the wear and tear of the building over its life cycle and counting that as a loss and expensing it, practically speaking, right? So just like a business pays for shipping and has a cost, so they expense that cost. So too, the purchase of your property, your real estate investment property, gets to be expensed over 27 and a half years or over 39 years, depending if it's commercial or residential. But basically, it's expensing your property over its useful life cycle. So, the way most people explain it is the wear and tear thing that, your building gets used, you walk on it, the carpet gets ruined, the walls get ruined, things break. So the IRS allows you to take that as a loss. And everyone gets so excited. Wow, it's crazy wear and tear because the building is still there, right? And this stuff is really true, but you'll see in a second what I'm getting at. But it's like, wow, this is insane. Like, I still have the building and I have this like invisible loss. That's why it's called a paper loss, because it's only a loss on paper. The building is still there. And people get very, very, very excited about this wear and tear business. I never loved the wear and tear explanation. It's just the only one that I had up until recently. That I did a little bit more research and got a little bit more clarity. So let's back up, right? Let's not talk about real estate. Let's talk about shipping costs. Let's talk about costs for product, wages that you're paying, rent that you're paying, all of these expenses for your business, you get to take immediately within the year, right? You pay $50,000 worth of rent, you get to take a $50,000 loss for your business regarding the rent. So if you only had a revenue of 25 grand, so your building, your business showed a $25,000 loss, right? So why buy real estate does it not work that same way? Why can't I just, I purchased something for $5 million. I purchased it instead of paying rent, I actually purchased the property that I'm going to operate my business in. Why can't I just take that $5 million and expense it? Right. So before we talk about land and, the building, right? Just like, why can't I take a $5 million loss? And the answer to that question is twofold. One is that it's too much, right? The IRS is not going to let people just, take out a loan, buy something for 10, 20 million or 50 million and count that as an immediate loss. Because then, even if they're grossing, $200,000, $300,000 a year, they're not paying a single dollar in tax just by simply expensing, right? So that's one of the reasons. And number two, the IRS says that since since you will get use out of this over a long period of time, so it's not like that shipping cost, or it's not like that, those the tickets that you purchased to fly across the country for a business meeting, or to visit your plant, or to whatever it is, whatever the expense is. Over there, you're getting the benefit right away, right? You ship that thing, takes 2 days to get there, bam, that was the value. You're not getting any value farther than that. You bought the plane tickets, you got the value, you took the trip, you went on, and that's it. You bought product, you paid wages, you paid rent, you got to rent the room for that month. So that is that you're getting the useful life, you're getting the benefit in 1 year, as opposed to real estate or any equipment for that matter that lasts a long period of time. Not every single, there will be exceptions here, but this is the general idea. Buy a car, buy a house. The IRS does not allow you to immediately expense that because you could expense it over its useful life cycle. So when it comes to a car, the IRS says it's 5 years that you get out of a car, even though, I don't know, some people seem to drive cars for like 15 or 20 years. But, the idea is that the expensing rules, when it comes to a car, the IRS is 5 years. Residential real estate is going to be 27 and a half years. Commercial is 39 years. And these are all just, the IRS saying that the useful life of this building is 39 years. So you're going to be getting this benefit for 39 years. You could keep the building for 100 years, right? But okay, whatever. It's not a perfect science, let's just say. So, one is the reason why you can't expense it right away is because it's too expensive. It'll be too easy to not pay taxes. And number two, that it has a useful life that lasts longer than just a year. So that's why you have to take it over 27 and a half and 39 years. So I like to call this expensing in slow motion. So while generally speaking, you purchase something for your business, you expense it right away. Over here, you get to expense it over a long period amount of time. And that is why it will take 27 and a half years. Now, is it true that there's wear and tear? 100%. But let's say there was no wear and tear. Let's say, I don't know, you just know how to use a building without ruining it, right? It's not really about the wear and tear as much as it is about the useful lifeness. So now the useful life really does go hand in hand with wear and tear because you only have a useful life over 27 and a half years because of the wear and tear. But anyways, it's not, this gives a better understanding. All right. So that is step one. All right. So step two, right? So when you purchase a property, what exactly are you depreciating? What are you not depreciating? We all know that land is not depreciable, right? So if you're doing a new construction, so you will be able to depreciate whatever goes into the construction. If you purchase land, you will not be able to depreciate that money that you spent on the land because land is not depreciable. It doesn't lose value. Its useful life is forever, right? Land's useful life is forever. Why? Because God created it. Anyways, it's not a religious podcast or YouTube channel, so we will keep it to that. But the point is that land value is not depreciable, and therefore you cannot take that as a loss. But the building on top is human made, and that does lose value over time because nothing we make lasts forever. All right, so if you did new construction, so simple, any money that's spent in the new construction in the building gets to get depreciated. But when you purchase something, you're buying the land and you're buying the building, right? So how do you split it up? Um, the most common method is to look at the tax property assessment of the land value of the local county, and they will basically allocate percentages to the land. There's different methods of doing it, getting, an appraisal by a third party. That would also work, but that's the most common method. Some of the purchase will go to the land and the rest will go to the building. And now the building you will get to depreciate over the 39 or the 27 and a half years. So now, really, right, this is just expensing in slow motion. So like, why is everyone getting so excited about real estate as opposed to any other expensing? So one is, that it's cool that you're purchasing a property that's actually going up in value. Whenever I mention depreciation to someone who's not familiar with it, they tell me that, whoa, 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 my property went up in value. I'm like, hold it, Charlie. All right. Your property went up in value, not because the physical building is appreciating, right? When you buy a baseball card in 1952, that thing is losing its useful life. It's, teeting away and it's, you have to go to very great lengths to keep it in good shape. But the fact that someone's willing to pay you $1 million because it's a rare card with a signature or whatever doesn't mean that the physical card is appreciating. It's the physical card is actually going down in value, the paper, but the fact that someone will pay you more, that's what makes it appreciate in value. So now, if you have a property that's in a good place and people are renting and rents are going up, so that property, even though the physical attributes are going down in value, its rents will go up and therefore it will have a higher selling value. It's not a contradiction. This is why people get excited with real estate, because it's like something going up in value and you're taking a loss for your taxes. So I guess as opposed to any other expense, you're just losing the money, and that's it. You're using it and you're losing it. So over here, you get to keep it over a long period of time. You get to sell it at a higher value, and you get to take its loss. So that makes it, quite fun and exciting, that real estate provides that value for you. But on top of that is that leverage here, right? Because to purchase a $5 million property, you don't need to come up with $5 million, right? If you're gonna, you know, pay rent, you're paying rent. All of that money is going to rent. But over here with property, you could put 20% down, you could put down less. So you could put down $1 million for a $5 million property. And then, let's say land is $1 million, so you're depreciating $4 million with a $1 million purchase. So that's also pretty cool. So you don't necessarily have to expense it. Now, I don't want to get into cost seg just yet, but if bonus depreciation is in play, you could have concepts where you purchased it for $1 million, but you purchased 5 million, you put $1 million down, and then you could depreciate $1 million in year one. So that's pretty cool, because that's sort of like a wraparound from the IRS not allowing you to expense things that are too expensive. Uh, with bonus depreciation, it's sort of a way of getting around that. One last thing is I wanted to just walk you through an example of what depreciation would look like if you purchased a $5 million property with regular depreciation on a 27.5 year schedule, right? So you purchase $5 million property, $1 million goes to land, let's just say 20%, $1 million goes to land, and then you could depreciate $4 million over 27.5 years. You're looking at taking a $140,000 loss on your taxes every single year for the next 27 and change years. So that is pretty cool. That is depreciation. And that's it. And that's it. All right. I hope you enjoyed. I hope to put out another episode real soon, hopefully next week. And hopefully these will get better. This is my first one, doing a whole episode on the video screen talking to myself. And it was a lot of fun. And looking forward to seeing where this goes. All right. Please like and subscribe, and follow me on LinkedIn, Facebook, Twitter. And have a great day. See ya.